Welcome to my market commentary for the second quarter of 2022. The quarter from the 1st of March has been extremely challenging for US, Chinese, European and Asian equity markets, as well as UK and US gilt and global bond markets. The only index that seems to have been fairly immune to the global slowdown, or slowbalization, as I've recently heard it termed, is the UK FTSE 100. Now, the FTSE 100 ended up roughly where we left it at the close of February after our last review, propped up massively by its overweighted exposure to old world defensive investments such as oil, gas and tobacco. The rest of the world encountered a brutal quarter, with two of the US markets having their worst start to a year since 1970, and one looking to have its worst start of all time. So what in the world is going on? Well, as we know, Russia chose to invade Ukraine just days after we concluded our last quarterly review at the end of February. This put considerable pressure on oil, gas and commodity prices, thus adding greater momentum to the global inflation locomotive. Shortly afterwards, China imposed massive lockdowns in response to their renewed COVID fears. And this squeezed global supply chains, thus throwing even more pressure into the inflation engine. This all came on the back of the impact of the Great Reopening and spiralling energy costs due to the collapse of multiple energy suppliers. The R word, recession, started getting mentioned in every news bulletin concerning markets. Then, central banks in the UK and US appeared to enter a race with one another to try and strengthen their own currencies by reducing monetary stimulus and increasing interest rates. Now, when you're importing a large amount of your food and commodities, you want a stronger currency. However, conducting the fiscal tightening required to achieve this when a recession is breathing down your neck is akin really to trying to train for a marathon when you've got the flu. Some key global markets are now in bear territory, having fallen more than 20% from their peak. This is most notable in China and the US, the world's two largest economies. Bond spreads have blown out for only the fourth time in the past decade. By this, we mean that the yields on newly issued corporate bonds have increased more than underlying gilts, and gilt yields are already rising at eye-watering levels. The US S&P 500 index fell by around 9.1% over this quarter, and its tech-focused Nasdaq index, which includes companies such as Apple and Microsoft, fell by around 13.3% over the same time period. In China, the Shanghai index fell by around 10.9%, and the MSCI World Index fell by around 17.1% over just one quarter. Here in the UK, 10-year government gilt yields shot up by around 142% over the year. This put huge pressure on usual safe haven assets, such as UK investment-grade bonds, as markets priced in considerable interest rate rises and the possibility of 6 times the current rate of defaults by quality companies. Let me explain. There are two things that ultimately give a bond its price. These are the risk of an interest rate rise and the risk of the bond owner defaulting on their payments. Currently, the average default rate on investment-grade bonds in the UK is around 1%, but the market is pricing them in as if there was 6% defaulting. In short, it is possible to see that elements of the global stock market are now overreacting to bad news. I think that this is good news for investors who are already in the market. No, I haven't lost the plot. One of the data sets that we consider when reanalyzing our client portfolios is something called the technical support level for markets such as the US Dow Jones. These support levels are historical break points that markets have managed to sustain trading above for discrete time periods, such as 30-day rolling averages in the past. Technical support levels are important because market traders will set their buy signals around these lines of defense. Now, it doesn't mean that a support level can't be broken, but with every support level the market breaks, it becomes that much harder for it to continue its downward trajectory. We agree with most market analysts that the Dow Jones technical support level currently lies around 30,000 points. At the time of writing, the Dow Jones is around 31,900 points. So this means that US markets may yet have a bit further to fall before potentially bottoming out. It's what comes next that excites us at Thomas & Thomas. The market bounce that follows a prolonged sell-off, such as we have seen, is always the reward for sticking to the plan. So many investors give up just before the markets fall that last bit, congratulating themselves that they got out just in time before the final horror show, only to then have to watch from the sidelines as the market tide turns, and for no real apparent reason, and sails on up past their panicked exit point, thus locking them out and crystallising their losses. Don't just take my word for it. There's a brilliant chart kindly provided to us by the people at Quilter, and you can see it in the printed version of what I've done today, and I would have a little look at it if I was you. There's some fantastic points on it which just show you past crises. Now the chart shows you how £10,000 invested back in 1992 would have grown to around £26,325 if left in a savings account all that time. It then shows how the same £10,000 investment would have grown to around £59,700 if invested in UK gilts and £95,936 if invested in the UK equity market. However, the really big gain was the global equity market, which would have seen the £10,000 investment grow to a staggering £140,637. Now, we can't be sure that exactly the same thing will happen over the next 30 years. However, market behaviour is very similar as we look even further back through history. Just look at the drops on the UK equity and global equity lines in that chart if you can, and what followed each and every drop. Now, I entered this profession in 1998, and time again I've seen these cycles. The news gets gloomy, markets overreact, crashes happen, and then recovery comes just when no one can see any point in continuing investing. In summary, it's been a really hard quarter and even harder year so far. I'm really proud of the way that our portfolios have managed to seriously apply some brakes to the falls in the market. Nonetheless, all of our portfolios have fallen, as so much of the world has been affected. I believe that we may see some further falls in the coming weeks. However, now is most definitely the time to be in the market, as history teaches us repeatedly what comes next. If China lift their lockdown, or a deal is struck between Russia and Ukraine, we will likely see market sentiment turn on a sixpence. If nothing happens in the immediate future, we may have to play a waiting game, but eventually things will change. We need to remember that inflation is only an annual number that is fed by previous months, so even as real inflation falls, the annual number takes time to catch up. We also need to notice that the underlying fundamentals of businesses are very strong. Banks and insurance companies are well capitalised, and businesses hold far greater cash balance sheets than they did a decade ago. The signals for a market rebound are starting to flash. I can't say exactly when this will happen, but I am excited about the longer-term prospects for all of our clients' portfolios from here. In the meantime, we're working really hard to squeeze out small victories from pockets of the market, which are really helping to stem short-term losses for you. We're here for you 100%. If you want to chat anything through, don't suffer in silence. I've found over the years that a quick phone call makes all the difference. So just call me if you're at all concerned. You're very, very important to me. My best wishes, and I will speak to you again very soon.